Successfully timing the market. Searching for timing the market, you will find countless articles and controversial opinions. Is timing the market a terrible or great idea? The truth, as so often, lies in the middle. Often this is referred to as balancing an asset portfolio periodically. Having said this, I have greatly accelerated my financial freedom by timing the markets. Furthermore, I'm in the process of protecting my assets and income streams from an oncoming potential downturn. Why it makes sense to time the market. So what exactly do we mean by timing the market? An investor trying to time the market is anticipating an opportunity. He/she will aim to buy an asset at a low price and sell it with significant gains. One of the most famous investors of all times currently carries well over $100 billion US. That is a sizable war chest waiting to be invested. It has been growing since his latest spending spree following the last financial crisis in 2008. In my humble opinion, Warren Buffett of Berkshire Hathaway is clearly timing the market. This is despite his famous advice to not try to time the market. The basic premise behind this is avoiding downturns to maximize gains and accelerate compounding over time. What's the difference, you might ask? It's truly unbelievable, really. The S&P 500 grew by an amazing 15,508% since 1965, the year Berkshire Hathaway was created. Over the last 54 years, Berkshire Hathaway's market value grew a mind-blowing 1,088,029%. When you invest makes a difference. Most articles are associated with only the stock market or equities investments. Many completely disregard varying asset classes and the interconnected growth cycles. Again, looking at Buffett, he built an empire over the decades, spreading his portfolio among all asset classes. He did so mostly by acquiring direct or full ownership of undervalued businesses during market downturn. Let's have a look at the acquisition timing for most of his fully controlled assets. It reveals a direct correlation to historic market downturns. Disclaimer: by no means am I a savvy investor. This blog post is written to provide my personal perspective and understanding on maximizing returns. I have practiced this method successfully to win my financial freedom. Asset classes and growth cycles. Let's go back to the asset classes. All business cycles and asset classes are interlinked. Looking at varying asset classes and their cycles, there are better or worse times to invest. Asset classes include equities and bonds, resources and commodities, cash and foreign exchange, housing, and precious metals. In times of economic growth, equities outperform most asset classes. During uncertainty, precious metals provide a safe haven, and we often see silver, gold, or recently palladium outperforming. Then there is the housing market, which generally grows alongside inflation in developed countries. In developing countries, housing tends to outperform, where salaries are rising quicker than in the developed world. The above are just some general observations, and each market should be assessed individually. It is very lucrative to understand the basics of asset classes and their growth cycles. It can significantly protect your investments as well as grow your return over time. Berkshire Hathaway, as mentioned above, is a prime example of this. Before we move on, please keep one last thing in mind. Investing across borders can provide significant opportunity for additional exchange rate gains. I use this technique to hedge against my investment in Poland. It took a few years, but I waited till the Polish zloty was the weakest in years. I exchanged my hard-earned dollars before my investment in Poland. This allowed for an instant 10% gain, today, or at the time 20%. This saving was basically worth one small apartment. Advice for novice investors. It takes years of learning, observation, and understanding to effectively invest across cycles, markets, currencies, and asset classes. Reading a few books won't make you a great investor. Practice, constant analysis, experience, and doing will make you one. This is the reason for why a savvy investor will advise a novice investor to spread their risk. This can be achieved by creating a balanced portfolio across asset classes. Take the time to observe, make small mistakes, and eventually learn. Novice investors are best advised to invest in low-fee index funds and simply ignore all business cycles. Grow a sizable war chest and then look for the best opportunities to multiply your savings in a safe way. Avoid being greedy, especially at the start. It could set you back years or worse, decades. In the meantime, read, learn, practice investing by starting with small and safe investments. My mistakes cost me dearly. I didn't do this for the first 12 years of my career and it cost me dearly. My career started just before the global financial crisis. I had no clue about investing and decided to put my 401k equivalent, Australian superannuation, in a so-called balanced portfolio. This portfolio was actively managed by a seasoned fund manager. It consisted of housing shares, commodities, precious metals, company shares, and a little fixed interest. What I didn't realize at the time was that I was paying excessive management fees. Over the years I learned not to trust financial advisors, bankers, real estate agents, or anybody that handles cash really. They just don't care as you and I would about our money. Observing the global financial crisis and following Great Recession was very disconcerting. Learning how the banking and monetary system works was even more sobering for me. My misguided trust in the financial system and financial advisors cost me over the years. I calculated that my financial mistakes amount to roughly $75,000. Over 30 years, until I officially reach my government retirement age, this is worth around $500,000 at 7%. Ouch. Sometimes ignorance is, truly, bliss. Time for change and self-education. Unfortunately, nobody is teaching basic personal finance management in school. While working professionally, we do not have the time to educate ourselves well enough. Most of us are too busy to read 30-50-page financial product legal disclaimers. If you don't, you might need to pay up for letting gamblers' fund managers overcharge you while underperforming. I certainly did. Today, I have educated myself with the bare basics of investing. By reading about an hour per day about markets and asset classes, I can today anticipate arising issues to some extent. More importantly, I can identify where and when it makes sense to invest or how protect my assets. Unfortunately, I never took the time to do this while I was working full-time. Goal: timing the market to beat the average. The average has always been my benchmark and I thoroughly recommend this measurement scale. I know it doesn't sound particularly exciting. Please trust me, however, if you constantly beat the average you will end up with a pretty good and stress-free life. Making fast money, risking everything, being greedy are the foundations for a roller coaster life. I haven't met many people on that latter path that are still walking the earth. Don't be one of them. You should try to be slightly better than the average Joe. When it comes to investing, this is twofold. Your goal is to gain more than the average during periods of growth. Analogically, you should aim to lose less than the average during recessions. Ideally, you set modest growth goals, anticipate when to get out of the cycle correctly, and rebalance your portfolio periodically. My strategies regarding timing the market. I have been timing the market several times to beat the average by following simple tactics. Invest when assets are sold below their actual value, and hold them for the long term. Transaction costs and associated work can destroy even the best returns. Australian property. Fiercely, I didn't buy property in Australia when prices were rising faster than wages for decades. The average Joe did, however, and that created a bubble. First, the average person feared missing out on getting into the market, now the average person fears of not getting out. Renting was cheaper, I calculated in 2007. It is still not a good time to buy into Australian real estate. Polish real estate. Secondly, I bought real estate in Poland, when I calculated it was undervalued in my city. In fact, I got very lucky and gained 26% in value last year alone. Of course, since I have bought the real estate for cash, I will decide when to sell it. Currently, I believe this will be in about 15-20 years' time. It is still a good time to invest in Poland. Minimize US dollar risk. Thirdly, I have minimized my dollar-associated cash holdings in anticipation of the US dollar falling over the next years. I prefer tangible assets for the time being. All global economic indicators are slowing. The financial system is still weak and recovering from the last disaster in 2008. Holding too much cash is an unnecessary and quite dangerous risk. The global banking system stands on shaky legs and a bail-in plans could result in disaster for the average saver. Protecting my retirement fund equities. Fourthly, I have hedged against the Australian market, by swapping my equities from shares to fixed interest. I anticipate real estate prices in Australia to further fall over the next 2 years. This has the risk of dragging down the economy overall. A potential US and Chinese recession would most certainly add to an Australian economic downturn. My preference is to only earn plus 2% in cash over losing minus 40% in equities for my retirement fund. I consider this fund as a potential bonus in retirement, as it is only accessible to me over 60 years of age. Going back to work. Whilst I consider myself financially independent on $40,000 a year of post-tax and fee passive income, I am planning for a family soon. There are several variables that I cannot fully prepare for. I do believe my income is too low given the uncertainties. Meanwhile, global economic indicators signal for problems on the horizon. To bolster my safety cushion, I have recently decided to go back to my old profession. The longer I wait, the smaller the worth of my established network and associated revenue generation capability. In addition, this might be the best time in years to return to the workforce. I anticipated hiring freezes due to an economic slowdown. The overarching aim is to increase my asset base to $2,500,000 and generate a passive income of $100,000 a year or more. I hope you find the above article and the 5 market timing strategies inspiring. Maybe you can adapt some for your own situation. As always, do feel free to share any thoughts below. For freedom and to live your dreams. Your Financial Gladiator.